Hi, my name is John Schaffer, and today I'll be doing a financial analysis on four different companies, and I will make three different decisions according to these statistics. The first scenario is I have $100,000 and to give out a 6-month short-term loan. Second scenario is I have $1 million and the companies are looking for a $500,000 loan, so I must pick one or two companies to provide the money for. Third scenario is that I have the opportunity to buy equity in up to two of the businesses. This is a brief company introduction, and I have Amedisys, which is a leading home health and hospice care company. Lamar Advertising, it's one of the largest outdoor advertising companies. And Microsoft, it's a producer of computer software. And lastly, I have Walmart, which is the world's leading retail store. Okay, so when dealing with a short term loan, there are three ratios that measure the liquidity of a business. And what the ratios are measuring is the company's potential to pay off short term debt. The first ratio is current ratio, which is current assets divided by current liabilities. The second is quick ratio, which is current assets minus inventory divided by current liability. And the third is cash ratio, which is cash divided by current liability. I'll be mainly focusing on the cash ratio because cash is the most liquid asset, and that is the most important when you're dealing with short term loans. So, when looking at a Amedisys, you see at 0.06, 0.05, and 0.16 over a 3-year span, those are pretty low. And moving on to Lamar, these are pretty low as well. In 2013, it starts off higher than it does in Amedisys, but as you get to 2014 and 2015, they're both decreasing. And Microsoft, as you can see, pretty much all of Microsoft's ratios are fairly high. And even though you see a small change from going to 2.06 in 2013 to 1.88 in 2014, you see that it rises back up in 2015 to 1.94. And you can still see that this is a great cash ratio, and also all the other ratios are pretty stable. And lastly, Walmart, the cash ratio is quite low, but looking over the past years, you can see that there's no big dramatic change. There's no big decline in any of the ratios, so that's still pretty good for Walmart. The short term loan decision, my choice would have to be Microsoft, and that's obvious because even though the quick ratio declined in 2014, you can see that in 2015, the next year, that it rose back up. And by all the numbers that Microsoft presents, it is easy to say that these assets will be enough to pay off a short-term loan. Okay, now on to the long-term loan. There are two key ratios, and these are equity multiplier and times interest earned. Equity multiplier is calculated by dividing total assets by its shareholders' equity. And what the equity multiplier is calculating is how much of the firm's assets are financed by shareholders' equity. So having a lower equity multiplier is better. And looking at times interest earned ratio, it's calculated by dividing earnings before interest and taxes uh, expenses and divided by expenses, divided by interest expenses. This shows the company's ability to pay the interest that it owes on its debt. So a high times interest earned is preferred, but whenever you see the firms with the really high times interest earned, this may be that they're inefficiently using their profit that they're making, or they're not reinvesting into the company. So you got to look at that also. A Medicis, the equity multiplier isn't too bad, but as you get to the times interest earned, you'll notice that in 2013 it is negative 35.12, and then in 2014 it just rises up to 2.93, and then back in 2015 it goes down to a negative 1.85. So in 2013 and 2015, it shows that the company probably just wasn't making enough money to cover its expenses. Lamar, the equity multiplier is a little high, but it's showing a slight decrease in 2014 and 2015 as it goes to 3.51 to 3.35. And its times interest earned over the years is showing a gradual increase, which is meaning that the company is making more money. Microsoft, the equity multiplier has a slight increase over the years, but it's nothing too dramatic. It's not going to make that big of a difference. But the times interest earned, as you see in 2013, it's 62.39, 2014 46.5, and in 2015 it is 23.25. While that is high, and as I said earlier, having a high times interest earn ratio could be bad. They could be using their assets inefficiently. But with Microsoft, you see that it's going down, so that may mean that they started reinvesting more money into the company, because in all the other ratios, the asset ratios, it doesn't show any dramatic change or loss that they're taking on. And lastly, Walmart. Walmart also shows a decrease in equity multiplier and the times interest earned, but again, it's nothing too big. It's 2.69 to 2.67 to 2.59. That's not all that bad. Even though it's a little high, it's still not going to make that big of a difference. And my decision on the long-term loans I'll be giving out will be to Lamar and Microsoft. Lamar shows a steady equity multiplier decrease, which is good. And while on the other hand, it's also showing an increase of times interest earned, which means that it's making more money. Microsoft, the equity multiplier is rising slightly, but just seeing that the 62.39 times interest earned ratio go from 23.25 in 2 years, that just makes me think that Microsoft could possibly be making a change in their reinvesting more of their profit into growing the company. And so that just is shows you that Microsoft will be able to pay off, and Lamar will be able to pay off this long-term loan. Okay. This last scenario was purchasing equity, and when you're making a decision on whether you want to purchase equity in a company, you want to look at the certain profitability ratios, and the ones that I have on these charts are return on equity, return on assets, profit margin, total asset turnover, and price earnings ratio. For equity, the main two that I'll be looking at, or mainly I'll be looking mainly at ROE, because that is calculating net income, and shareholders' equity. So that's really important to know what you have for ROE because that tells you how much profit of a company you're generating with every dollar, and those dollars are coming from shareholders' equity. So for Medicis, the return on equity, the ROA and PM, as you see in 2013, the ROE is negative 23.33, and then it raises slightly to just a 3.32, and it drops back down to a negative number at negative 0.75. And again, pretty much it has the same pattern for ROA and profit margin. They both start at a negative number, rise up just slightly, and then drop back down to a negative number. And for Lamar, you see that the ROE starts out at slightly low at 4.43, which really isn't all that bad, but you see in 2014 it rises all the way up to 26.45, which is a great change. And even though in 2015 it drops just very slightly to 26.19, that shows that they made a lot of profit and they're using a lot of the equity that's invested. They're using that to produce things, and they're using that in a positive way, and that's good for if you're wanting to invest in a company. That's good to know that they're doing that. For Microsoft, through all Microsoft's numbers, they're good, even though you see that the ROE starts at 30.09 and is decreasing. Still in 2015, still at 14.36. That is really good. And same thing with ROA. It starts out at 16.58, but in 2015 it ends up at 7.03. I mean, that's still higher than most of them. That most of them end up in 2015. But and leading off to Walmart, lastly, Walmart is also showing a slight decrease in its ratios, but the ROE starts off at 23.02, and it just decreases to 21, and then in 2015 it goes from 20.76. So all that in 2 years, that's only about three points of a change. And same thing with ROA, and the same thing with profit margin. Profit margin actually increases a little bit from 2014 to 2015, but it's only 1 point. So my decision on investing or buying equity in a company will be Lamar, and this is due to the fact that you saw the great increase in return on equity and return on assets, which that separates itself from all the other companies, and all the other ones pretty much declined. May not be much, but just Lamar showing that it is using its equity efficiently and it's using it to grow the company is good to see when you're wanting to buy equity in a company.